GDP one day, inflation the next, then earnings or jobs. But by the time they hit your screen, it's already too late. By the time it's released, it's already been priced in for days, and the opportunity is gone. So the question is simple. What moves first? What comes before GDP? Before earnings, unemployment, or inflation? What is the first domino, the signal all others follow but none can lead? Now take a look at the markets. Start with the S&P 500, a broad equity index built on US large caps. Then Nvidia, a single stock driven by innovation and speculation. Now Bitcoin, a decentralized asset outside the traditional system. Then gold and silver, historical hedges anchored in scarcity. And finally, the US dollar, a global reserve currency often moving in the opposite direction. Different assets, different fundamentals, different stories. They all respond to the same hidden driver, to a common source of fuel, a flow that feeds them or drains them. One global signal, one master indicator, a metronome for risk showing you the next move before it happens. That's why at Glacium Research, we built our own model, a custom indicator designed to capture the one signal that consistently drives market movements. A framework we developed in-house, built around one simple question. What comes first, before the rest follows? What's the first spark, the one that can't be forecast, but that we can track in real time? And today, we're going to walk you through it. Before we explain its exact components, it's important to understand what comes first. The world economy is a machine made of nations, each one controlled by a central bank. They don't just observe the economy, they steer it, and they do it through one tool, more powerful than any other, the ability to create money. They expand the supply of currency, digitally, instantly, at scale. With one keystroke, billions are injected into the financial system. That's the first domino. Before a job is created, before a product is sold, before a yield curve inverts, money is created. And when it is, it doesn't stay where it was created. Because in today's world, money moves instantly, across borders, across currencies, and across markets. When the European Central Bank expands its balance sheet, a part of that liquidity is immediately converted into dollars, typically via the global interbank market. A hyperliquid, real-time system designed to move capital instantly and at scale with almost no friction. It's then used to buy US stocks, to speculate on crypto, to chase returns wherever they still exist. Same with India, same with China, same with Japan, Canada, or the UK. Every time a central bank prints, a portion of that liquidity escapes its borders, because capital is global, and it always looks for yield. That's why we don't track just one central bank. Not the Fed, not the European Central Bank, not the Bank of Japan. We track them all, together as one system. Imagine it like a giant pool, a global pool of liquidity. Each country adds or removes water. Quantitative easing adds. Quantitative tightening takes away. And the total level of that pool is what we call global M2. Here, at Glacium Research, we built our own indicator to monitor this global pool. Here's how it works. We take the M2, the broad money supply of the 20 largest economies in the world. Not just the US, Europe, or Japan, but also China, India, Brazil, Canada, the UK, South Korea, and more. Each country's M2 is converted into US dollars. Then all of them are aggregated into a single, unified measure. The result is the real-time global liquidity, adjusted for currency effects, updated with each central bank release, and structured to reflect the actual flow potential of capital worldwide. And that distinction matters, because for decades, investors have focused almost exclusively on US liquidity. But in a world of free capital movement, that's no longer enough. Liquidity created in Tokyo can drive asset prices in California. Liquidity withdrawn in Frankfurt can tighten conditions in Brazil. That's exactly what happened in 2022, 2023, and even early 2024. While most analysts and funds were focused on a tightening Fed, expecting risk assets to fall, markets were rising. Why? Because global liquidity was quietly surging elsewhere, and the rally began, long before most understood what was fueling it. That's why we built Global M2, not to replace local indicators, but to see the full picture, the real picture, and that signal is the one we track. This is the first domino, not in theory, but in flow, because this pool is where every market drinks from. Stocks, crypto, commodities. They don't rise from nowhere. They rise from this pool when it's rising. And when that level falls, everything else follows. And now, look at what's happening. Global M2 is rising fast. the trend is accelerating. After months of hesitation, the Federal Reserve has joined the cycle. And today, almost all major central banks are injecting liquidity again, hard and continuously. Japan, Europe, China, India, the US, Brazil. They're all adding to the same global pool, and that changes everything. This is one of the key reasons why we remain structurally bullish on equities. We expect new highs in global stock markets and the continuation of a broader risk-on wave. In crypto markets, we also anticipate further upside. If global liquidity continues to expand, we expect the typical late cycle pattern to unfold, a rotation from Bitcoin into Ethereum and then into lower cap altcoins, what the market often refers to as alt season. Historically, we've never seen that phase occur without a weak dollar, and this cycle is no exception. The dollar began to decline just ahead of this final stage, removing one of the last barriers to broad crypto outperformance. It's not a coincidence. At Glacium Research, we don't just monitor price, we monitor the creation behind the price. Because following global M2 is more than tracking an indicator, it's watching the source, the creation itself, that drives the entire market.